Welcome to another episode of the Worth Listening podcast and the series Know Better, Do Better with my girl, Chloe Moore. So if you have not been listening to the last few episodes, Chloe and I decided to do a comeback series specifically for those who have stock options or stock compensation. So our first episode was about RSUs, restricted stock units. Last episode was about ISOs and NQSOs. I know there's a lot of letters that they get put together as it pertains to stock options. And ISOs and NQSOs are different types of stock compensation. But today we are talking about employee stock purchase plans, better known as ESPPs. Chloe, welcome to the show.
Thanks for having me once again.
All right. So today we are going to cover the ESPP basics. We're going to help you understand a little bit more about when it makes sense to participate. And then also that big question that everybody wants to know, to sell or not to sell. What should I do? How long should I hold on to them for? So let's just start by jumping in and breaking it down with what is an ESPP, Chloe?
Sure. So an employee stock purchase plan, I know we're talking about kind of stock compensation. This is more along the lines of an employee benefit, but I like to put it in that stock compensation category. So employee stock purchase plans they basically allow you as an employee to purchase shares of your company's stock at a discount. And so, on the surface, it sounds like a great thing to do. It sounds like a no-brainer. But there are some things to think about. And so we'll get into that.
All right. Well, as we think about it, I guess the first thing we should probably cover is kind of the basics of, I know that they come out of your payroll generally, there we go. But how do employers even decide like how much is going to come out? And, how does it just work in general if you decide you want to opt into participating in ESPPs?
Yeah. So like I said, these allow you to purchase shares of your company stock at a discount. And so it's through payroll deductions is how it's done. So generally speaking, employee stock purchase plans, there is a limit to how much you can contribute. And this is all just based on, laws that are in place. But most plans limit your contributions to a certain percentage of your income. So just like you contribute to your 401k, you do a certain percentage of your income. You can also do the same for an ESPP. Typically, there's a limit, and so it's usually about 10 or 15% is the max that you can put into this type of plan. And then there's also an annual purchase limit, which is $25,000. So basically, what you do is you decide there's an offering period where you can sign up for the plan. And then once you're enrolled, basically you take a percentage of your paycheck, and this is after taxes are taken out. So it'd basically be part of your take home pay that you're sacrificing to put into this plan. And so they deduct that amount each pay period, and they'll do it for a certain period of time, which is usually about 6 months at a time. And so every 6 months you can choose to enroll into the plan. And so that's the purchase period. So your company basically just holds on to that cash for every pay period for the next 6 months. And then at the end of the 6 months, they'll buy the stock at a discount. And so this cycle just repeats every 6 months until you decide not to participate anymore. Gotcha. So that's kind of generally how it works.
Okay, so you said a few things that I think we need to circle back to just to like summarize for everyone. You said that it's generally going to be up to a certain percentage of your income, typically 10 to 15%. So that right there is a game changer. If you make $100,000 and they said, if we're just talking numbers here and you're sitting in the car or on your run listening to us, 10 or 15%, like 15% of your income, like $15,000. So you're going to be wanting to think about your budget as it pertains to, because you said this is also after tax money. So this is going to reduce your take home pay. What does it look like to reduce your take home pay by 15%? And then there's other things to be thinking about. Like you said, if you're already putting money into a 401k or, you've got other things you're trying to pay down debt. So I think that's a really helpful thing, is kind of like one of the basics that helps people kind of sort through how much should I contribute? How much can I contribute? Like you said, you don't just want to say like, ooh, stocks, this sounds fun, let me do it. You need to be thinking about, like you said, what's going to happen if I participate. And then you also mentioned like an annual limit of $25,000. What I was thinking of when you were talking about that is the idea that, nobody wants to take or be holding the ball if someone has too much of one kind of stock. So they're limiting the amount that you can purchase because they don't want to say like, oh, 99% of your portfolio is your employer stock. So it's like, let's put some guardrails in place to be able to say, this is the amount that we're going to allow people to be able to participate in. So those are some cool things to think about. And then that you can do it, you said twice a year, usually every 6 months. So there's opportunities to kind of opt in and opt out if you feel like it's not right for you. Is that accurate?
Correct. And there are some cases where, if you sign up and commit to the 6 month period, there are some cases where you can back out, but generally you want to make sure that you can commit to that full 6 months.
Have you ever seen any penalties or anything like that if you do back out?
No, it's just a matter of, does your company allow you to back out if needed?
All right. So what else do we need to know about the basics?
Yeah. So I can give an example just to, if that would be helpful. So let's say your company allows you to buy into the program. So the ESPP. And so basically, let's say you make $150,000 for round numbers. So you enroll in the plan in November. And so you start like in January. So it goes from January to June is the 6 month period. So let's say you want to put 10% of your salary into the plan. So if you're paid bi-monthly, that's $625 that comes out of each paycheck that's taken from your take-home pay over the next 6 months. And so over that 6 months, your company's accumulated $7,500 into an account, and then they purchase that stock at the end of that period. And so basically, the company can give you a discount that could be, it varies from company to company, but it could be anywhere from 5% to 15% off of the fair market value of the stock. So if the stock's, valued at $35 a share, then you can get a 15% discount on that price. So basically, your dollars can go a little bit farther, and you're able to buy that stock at a little bit of a discount.
I like it. I think everybody loves a discount. So to be able to purchase something at a discount, one of the things that I think stands out about ESPPs is the idea that the money is basically being set aside for you to purchase the shares at a set date. Whereas, RSUs we talked about earlier on, that's not how that works for them. And then ISOs and NQSOs, we actually talked about the idea of, you having to come up with this, like there's not a preset plan, whereas this is kind of like, let me put a little bit of money aside to make sure that I have what I need to be able to purchase. The company's doing all that, which is, like I said, is actually an employer benefit. Like, because I think that's one of the hardest things people with stock compensation come up against is not being able to actually participate because they don't have the cash on hand to be able to participate.
Yeah. And then there's another thing that's really cool. And in addition to having the discount, some companies offer what's called a look back provision. And so with this feature, basically your company can buy the stock for a discount, but they look back to what the price was when you first enrolled in the plan versus the price on the purchase date. And so you might get even a higher discount. And so in the event where, like, say you buy the stock at or on the date that they purchased the stock, the value is $35 a share. Let's say when you enrolled in the plan 6 months ago and elected to take those amounts out of your paycheck, let's say the stock was at $25 a share. So they might give you a discount off of that lower amount, the $25 a share, instead of the current price. And so they look back and they say which price was lower, and we'll give you the discount on the lower price. So it really is more than a 15% discount in that case. So that could be a very, very beneficial thing.
I like it. And so the thing that stands out to me as you kind of describe this is, like you said, once again, this is the stock market. So we don't know what's going to happen. You could be the lucky beneficiary of, you get to buy at this cheaper price and your company's stock has gone up. Or, it could be a situation where the, current price is the discount that you're going to get, but you don't have control. And that's one of the things I always like to drive home with my clients is you don't get to say, okay, stock market, go up now, stop right here, go down. You're relinquishing control. You're taking on a certain amount of risk. But that's also where you get to, maybe possibly reap the rewards or in the form of gains.
Yeah, that's true. The stocks do not always go up, just like the price of housing and everything else does not, or housing prices always don't go up. So there is a chance that things can go down for sure.
Mm-hmm. There's also these terms, qualifying disposition and disqualifying disposition. Could you just kind of give a short rundown of what that means and how that might be relevant to someone who has ESPPs?
Yeah. So yeah, let's talk about taxes quickly. So basically, when you only owe taxes when you sell the shares, and not when they're purchased. And so basically that discount, like we talked about so many times before, nothing's free. So the discount that you receive, that is, taxable to you as ordinary income, because it's like your company's giving you that discount, and you're buying the stock at a lower price. So the difference between the price that you purchase it and the current price, the current value of the stock, that difference is taxable as ordinary income. So basically, anything beyond that, if you decide to hold on to the stock and you sell it at a later date, if you sell it right away, you just log in that discount. And so if you decide to hold on to it, basically, of course, the stock price can go up or down. And so it's subject to capital gains taxes, basically from the amount that you purchase up to what the amount would be, or the value would be when you sell it. And so if it goes up, there's capital gains taxes. And if it goes down, then there's a loss. And so there's two terms called qualifying and disqualifying position. And so those are, I won't get into like the details, but those are some special rules about how long you hold a stock after it's purchased. And then if you receive preferential treatment, or lower capital gains rates on the gains.
Okay, so that was a mouthful. I think the one point to summarize here is that there's either ordinary income, which is the equivalent of whatever tax bracket you're currently being taxed in, or the capital gains aspect of things. And there's different ways to qualify for one versus the other. So you need to know what tax bracket you're in. This 150K maker, I think they would be in the 24% tax bracket, right?
Yeah.
And then, if you got capital gains, there's 0, 15, and 20%. So like, which of those brackets do you fall in based on your income? You might want to be able to say like, okay, I know I'm in the 15% capital gains rate. That, the difference between 15 and 24% or 22%, and, bad math there, 7 to 9% difference is like, wow, okay, that could be maybe worth it to make sure that I put myself in the right situation to be able to take advantage of capital gains. So, it's something you need to consider and something you need to work with a professional to decide, which one makes sense for you.
Yeah, and the key is that discount's always going to be taxed as ordinary income. So it's really just up to you to decide, if you should hold or sell beyond that.
Should we talk about holding to sell now? Or I think before we go to that, we should probably talk about like, when does it make sense to participate? So we've kind of broken down like what it is, how it's taxed, but should I just automatically enroll if I have ESPPs available to me at my employer?
Yeah, so I think if you have a 15% discount, it's very attractive. If you just have a 5% discount, it might not be worth the hassle. But the higher the discount, the more attractive the plan is. And then also, if you have a look back provision, that makes the plan more attractive because you can get an even deeper discount. So basically, if you have, let's say, a 15% discount and you have a look back provision, it's kind of a no brainer as far as when you participate. But does it necessarily make sense for you? And so the big question is, what's your current situation, your current financial situation, and what does your cash flow look like? So, thinking about your current situation, are you at least contributing to your company 401k up to the match, and taking advantage of that free money that your company's giving you? Do you have emergency money saved? Do you have credit card debt or personal loans or any other high interest debt? So you want to make sure that you cover some of those things because, like Lauryn and I said, this reduces the amount of your take home pay. And so if you're not able to cover all of your living expenses and take care of your debts or other things that are higher priority, then, you want to cover those things first before you start contributing to an ESPP.
And if this is an option that's available to you, you can enroll in it later. So maybe, the first year or two of having this available to you, you don't participate because you're trying to get a strong foundation in place because you've gotten a new higher paying position at a better employer that has all these great benefits. But it's okay to say like, okay, this is really cool, but I'm going to set a goal to be ready to participate in my ESPP plan by X date or X enrollment.
Yeah, and that's the great thing about it. I mean, you can always enroll. I mean, there's certain periods of time, of course, but yeah, you can enroll at any time that you're employed with the company during those enrollment periods. So it's not something that you miss out on. You only have one time to participate. The cycle comes along every 6 months or so, or possibly every year or so. So you can always do it at a later date when it makes more sense.
Okay. All right. Let's talk a little bit more about that sell or hold, because we kind of prefaced it a little bit that we went away from it. But I think that's one of the biggest things people come up against is, oh my goodness, I want the stock to go up. I want it to do awesome. But also, like you said, this is something that you're taking on some risk. So what are some things people should be considering when they actually get these stocks and they've got to decide, do I sell now or do I hold on to them?
Yeah, and so with any type of equity or stock compensation, there's decisions that you have to make. The first one is, should you participate? So we just talked about that, and then the second one is, what do you do once the shares are purchased? Do you keep them or sell them? And so you have a couple of options. You could sell the shares right away. So as soon as they're purchased, you could sell them and just lock in that discount. And then the other option is to hold the shares. And so, depending on when you sell them, like we said, there's different tax consequences if you sell them before, meeting what's called a qualifying disposition, or after what's the qualifying disposition, and getting taken advantage of those taxes. The only thing to think about there is, the opportunity to benefit from lower taxes sounds appealing, but there are some considerations. First of all, the stock can go down. And so, stocks don't always go up. And so you need to, understand that you are taking a little bit of risk there. The other thing is, would you, similar to the RSUs, you can go back and listen to that episode. But we talk about the question, if your company gave you a cash bonus with RSUs, would you turn around and go buy your company stock with all of your cash bonus? And the answer is typically no. So with the ESPP, would you go out and buy your company stock even if you didn't have this program? Is this a stock that you would purchase anyway? So that's a question to ask yourself. And then also, could the proceeds, like if you sold the money right away, you're taking a little bit less home from your paycheck to participate in the plan. If you sold it right away, could that money be used along with the discount after taxes to fund other financial goals that you have? So, if you sell it right away, you could take advantage of that discount, get a little bit of extra cash for participating, and then use that money to fund other financial goals. So those are just kind of some things to think about. And then, the big thing that we talk about with all of this is how much of your net worth is tied up into your company stock, and knowing that your company also pays your paycheck. So if something bad happens with the company, you might lose your paycheck and most of your net worth. So that's really risky to have, in any large portion of your net worth or your investments tied into a single stock.
Yeah, no, I think that's a really great point, is the risk that you're taking on by, one, being employed by that place, but then two, having tons and tons of the stock at that particular place versus a well-diversified portfolio. One of the things I wanted to circle back to, we talked about it a little bit with RSUs, but we talked about tax ramifications of ESPPs. If you're going to, exercise and sell immediate, like, is there a way that they can hold that money in your paycheck, or is that something that you need to plan for and set funds aside as it pertains to whatever tax liability you may be looking at regarding the ESPPs?
Yeah, it's something that you have to plan for. And so you need to make sure that you're setting aside the money to cover those taxes.
Yeah, I know we talked about that being the case as well for ISOs and NQSOs, and, this tax liability kind of being pushed down the line. So it's like, you need to plan ahead, set the money aside, because someone's going to tell you later, hey, you owe this much. And you're like, wait, what? So same situation with the ESPPs, is that the responsibility falls on you. Whereas with the RSUs, they're going to withhold immediately, whatever at the proper withholding rate. So just something else to consider there.
Yeah, and this is why it's so important. I always tell people, if you have some form of equity compensation, or if you're participating in your ESPP, it's super important to make sure that you're working with, at the bare minimum, a good CPA or a tax preparer that understands how these things work and can really help you prepare. Like if you're working with someone who's proactive and they're not just kind of taking all of your information at the beginning of the year and plugging it into your tax return, if they're really kind of helping you plan ahead, they can run some calculations towards the end of the year and say, hey, this is what we expect you to owe. And so make sure you have that money set aside, and they can kind of work with you throughout the year. But, at bare minimum, work with a tax preparer or a tax professional that can help you kind of plan for these things. And then also, work with a financial planner.
What she's saying, the translation, the layman's terms, is don't be a cheapo. Yes, both of those professionals cost money, but imagine how much a mistake could cost you. And being hit off guard can totally knock you off your feet and take you months or even a couple years to get back headed in the right direction. So definitely want to consider working with people whose job it is to know this stuff, look at this, be able to, like you said, plan ahead, let you know what you're maybe not considering. So that is not a big costly situation that we're unprepared for. So yeah, that's good advice. All right. Any other thoughts as we wrap up ESPPs?
Yeah, I mean, I'd say just in general, if they have a great discount, like I said, it's a 15% max. If they give you that discount, if they have a look back provision, it really is a no brainer. It's just a matter of figuring out, can you afford to take home a little bit less to participate in the program? And then also, do you understand if it makes sense to hold or sell?
Mm-hmm. Which means you need a budget. If you want to know if you can afford it or not, you need to know what's coming in and what is going out. My girl Chloe is an expert at equity compensation. Like you said, I had to bring her back to talk about RSUs, ISOs, and QSOs, and ESPPs, all the letters, all the alphabet soup.
Yeah.
Chloe, why did you choose to work with professionals in tech? Why are you passionate about this area?
Yeah, it was funny. I didn't really choose it. I feel like it chose me. And so when I started working with young professionals, I just started attracting a lot of people in tech. And so I think that's just something that, a lot of young professionals who are making great money these days are in tech. So a lot of them were looking for some help. Their situations can be a little bit more complicated than the average person. And so it was just a great opportunity for me to help, people that I really enjoy working with.
Yeah, I know you also, before starting your own firm, you were working with kind of the uber wealthy, if you will. And so you have a lot of expertise in complex tax issues and estate planning and all of the different things that are financial planning. So I think that probably lends itself to you being able to deep dive into equity compensation and really dig into the details and get a good understanding. Would you say so?
Yeah, definitely. And I would say before this, all of these tech companies became popular and all of these different, creative compensation packages. Typically, if you had some form of stock compensation, you were an executive or you were really high up at a company. And so with tech companies now, just about everybody can get some form of stock compensation. And so it's more common if you're just a regular individual contributor at your job and you're not, the high up executive or like the C-suite, then you can still receive this type of compensation. So I was able to take that knowledge that I learned from working with these corporate executives and these highly ranked employees to take that and use it to help young professionals who are getting the same type of complicated compensation.
I love it. Filling a gap. That's why we get along so great, because there are various gaps within the financial industry. And we're both really, really excited about being able to fill the gap and fill it in the best way that we know how. And so being able to, like you said, help the masses who are now being compensated with stock compensation or equity compensation, but not having no idea what to do. Like you said, there's not any additional financial literacy being shared. I think it's a really cool niche that you have. So tell people where they can find you. It's always in the show notes.
Sure. So you can find me on my website is financialstaples.com, but you can also find me on Twitter and Facebook at FinStaples, and then on Instagram at Financial Staples.
All right. This has been the last part in a 3-part series on equity compensation. And it is our second ending to the Know Better, Do Better series. I'm sure I'll convince Chloe to come back for yet another something. But it has been wonderful having you yet again. And ciao for now.
Bye.